talk about in 12 months and then 24
Yeah,
months.
that's that question on the exam that asks, what the relationship is between the yield curve and the stock market and the economy. From our calculation, from what we've seen, is when the yield curve inverts, the stock market peaks in less than 12 months, and we're in a recession in less than 24. Okay. The yield curve is totally flat right now in the United States. It actually is inverted in some emerging markets, and actually the swap curve inverted twice last year. So we're pretty close to an inversion. You usually need an inversion of at least 150 basis points above the long rate to have a major impact on the markets. So we're pretty close. The Fed has stopped raising interest rates and they've stopped selling off their bond portfolio because they didn't want to invert the curve severely, because they knew if they did it, we'd go into a severe recession. So far, it doesn't look like a recession until 2021. That's the consensus by most economists, but we'll see what happens. The Fed may actually get lucky. We may get lucky and skip it, not have a recession for another 2 years. I'm just saying, if they invert, if they keep raising short-term interest rates, keep selling off the short end of their bond portfolio, it's going to invert the curve. They stopped, selling off the bond portfolio and stopped raising short-term interest rates because they didn't want to invert the curve. They flattened it, but they didn't want to invert it because they knew we would be in trouble if we did. Okay. I've never used this, so I'm not sure how it actually works. So here's the curves again. And then the four theories, the expectations hypothesis, which is the Fisher equation, because nominal interest rates are driven up and down by inflation expectations. That's the expectations hypothesis invented by Irving Fisher. Then there's preferred habitat, market segmentation, and liquidity preference that basically state that the yield curve is segmented into short-term, medium, and long-term maturities. The market is segmented. And that different participants in the market for treasuries prefer to be they borrow and lend either on the short end, the medium term, or the long term. For example, corporations borrow and lend on the short end of the term structure, or the yield curve, because they have inventories, and they're holding inventories, and inventories spin, so they need to finance the inventories using short-term debt instruments. With pension funds and endowments, they want to buy long-term bonds because they're trying to match their asset and liability matching, because they want their assets, particularly the bonds, to come due and pay the premiums when their pensioners retire in the future. So they're matching their asset lives with their liability lives. Okay. What else? What's the #1 tool used to regulate interest rates by all global central banks are through open market operations. Although the Chinese central bank decided to lower reserve requirements, which was a pretty drastic move, by their central bank to inject liquidity into the system. And as of today, I found out that actually that liquidity, by lowering reserve requirements, is actually moving through the economy and is now starting to stimulate economic growth. Yes, go ahead.
You said the #1 tool is something is
Yeah, the #1 tool used by all central banks to drive bond prices up and down and interest rates up and down is through the use of open market operations. Okay, so there's really three main tools. Open market operations, here in the United States, it's the federal funds rate, and then reserve requirements. Reserve requirements are used in drastic periods to inject liquidity when it looks like your economy's going into a recession.
They would lower reserve requirements.
Exactly, and that would create an accelerator multiplier effect through the fractional reserve banking system that would create all this liquidity that then would be lent out to businesses and individuals to spur consumption and investment. Okay. So open market operations. Let's see, dynamic asset class supply demand analysis. How am I doing on time? How much? Okay, I should be able to get through this. So here you got the supply curve and the demand curve. Obviously you're going to start off at equilibrium, at the quantity supplied. At equilibrium, you're going to get the equilibrium clearing price. You're going to shock the supply curve. It's either going to go back or shift out. And then the demand curve, it's the same thing. You have basically supply demand in equilibrium at the quantity demanded to get the equilibrium price. Then you shock the system and either the demand curve shifts up or shifts down. What for stocks, what would cause the supply curve to shift back? Basically stock buybacks. Okay, you're going to eliminate supply. Let's see what else we have. Positive supply shocks that would cause the supply curve to shift out would be initial public offerings, stock splits, and secondary and season offerings. On the demand side, positive demand shocks would be higher GDP, production, employment, real wages, savings, investments, and earnings, and lower interest rates. What would cause the demand curve to shift down would be a recession or depression, falling prices, disinflation, and falling earnings. Okay, so that's the shocks. For oil, what would cause the supply curve to shift back would be OPEC production cuts, supply shocks, disruptions to the supply lines, such as wars in the Straits of Hormuz, in the Middle East. What would cause the supply curve to shift out for oil? Technological innovation, electric cars, fracking, and alternative renewable energy also. What would cause the demand curve to shift up for oil? Higher global growth. Particularly in the US, China, and India. And then what would cause the demand curve to shift down would be recessions and depressions. As you start to read these articles, on the asset classes, you can add other factors in there that would cause the supply curves to shift back and out and demand curves to shift up and down. So as you start to read the articles, you want to have this microeconomics in your brain running the supply-demand analysis. And then that way you'll be able to forecast where the prices are going to go. For gold, what would cause the supply curve to shift back? Negative supply shocks, supply cuts, hoarding of gold by central banks. Actually, Russia is hoarding and actually starting to take on more gold reserves now to anchor their currency. What would cause the supply curves to shift out? Higher levels of mining or extraction, technological advancements in mining and extraction, and central banks selling off of their gold reserves. That was a big deal in the Middle East and in Russia. When Russia was in their recession not too long ago, and the Middle East was getting hammered by lower oil prices, they didn't have enough US dollars or foreign currencies to pay off the US dollar in foreign currency denominated liabilities, so they had to sell off their gold reserves to raise the foreign currency that they needed to meet their liabilities. Positive demand shocks for gold. Political instability. Geopolitical instability is one of the #1 factors. High and rising inflation and inflation expectations. Hyperinflation in Venezuela is a good example. And then currency devaluation by central banks. A negative demand shock for gold would be higher stock in real estate prices and returns. Because why would I hold gold or bonds when there's not a lot of risk out there? I'm going to shift out of safe liquid assets and I'm going to shift into riskier, higher return assets. Political stability, deflation and disinflation. Gold is a hedge against devaluation, deflation, and disinflation. Does everybody know the difference between deflation and disinflation? And actually, when you read the media, they always get it wrong.
Is deflation when your inflation rate is still rising but it's just dropping, and disinflation is when it's negative? Or is it the opposite?
Yeah, okay, so you're close. Disinflation is when you have falling commodity prices. Deflation is when you have falling asset prices. So falling stocks and real estate values would be deflation. falling food and other types of commodity prices would be disinflation. Okay? Everybody gets it wrong.
Well, so deflation is basically.
Asset prices. Real estate and stock prices are falling. Disinflation is commodity prices, corn, wheat, actual food prices, commodities.
Okay.
So
It
one's
has
asset
nothing
price-
to do with the actual rate of growth, because as I remember, disinflation was like when the growth rate slows, but it's still growing, but deflation is when it goes down.
Disinflation is when the commodity prices fall, and deflation is when the asset prices are falling.
Okay.
That might be part of the definition,
Okay.
but from what I know,
Mhm.
deflation is asset prices, disinflation is commodity prices.
That's a good way.
Okay. All right, and then for the bonds, what would cause the bond curve to shift back? The government actually runs a budget surplus, and they decide to retire some of the bonds outstanding. The other is, currently the Fed is holding like $4.3 trillion on their balance sheet, mostly short-term treasuries and mortgage-backed securities. The supply curve could shift back when those bonds reach maturity and roll off the balance sheet and not be replaced. Okay. The other is what would shift out the supply curve, structural budget deficits, which is what we're looking at right now. So we'll probably hit about $1 trillion this year, $1 trillion every year for the next 10 years, maybe 20 years. So we'll probably see our debt double, total debt outstanding of 22 trillion double to like 48 trillion in the next 20 years, which is totally unsustainable. What would cause the demand curve to shift up? Falling interest rates, falling inflation, recession fears, low and falling stock prices, and real estate prices and returns. What would cause the demand curve to shift down would be lower stock market returns, rising inflation, earnings expectations, rising interest rates. Okay, on the US dollar, what would cause the supply curve to shift back? Low money supply growth rates, hoarding of dollars, and low interest rates and inflation. What would cause the supply curve to shift out for the dollar? Money supply growth rates, selling by the Treasury and the Fed of bonds. What would cause the demand curve to shift up for the dollar? Higher productivity rates, higher expected returns, higher interest rates, higher returns on stocks, bonds, and real estate, low inflation. And what would cause the demand curve to shift down? Lower expected returns on bonds, stocks, and real estate, low labor productivity. And those are some of the factors. Okay. And as you start to read about currency values, a lot of these factors start to come up. How am I doing on time? 2 minutes. 2 minutes? Okay. I'll tell you what, I'll go through the rest of this on Monday. Hopefully this is helping you fill out the pre-test for some of you who hadn't taken my class or taken my class. And this gives you kind of a solid foundation to then start moving forward. And for those who did take my class, this is a good solid review of some of the fundamentals that you really need to know. Okay?